Hello, everyone, and welcome to another episode of Squad Academy, where two friends turned PE fund managers talk about the hardest topics in the US economy and enterprise software space. We have a special guest in the building, Jude, Mr. Jude Omodon. How you doing? How you doing?
I'm doing good. I'm doing good. Thanks
Okay,
for
good.
inviting me and thanks for
Awesome.
having me on.
Awesome. Now, I mean, this is going to be a fun conversation. Jude is a P associate at one of the top firms in New York. And we'll talk about that shortly. But today is going to be a very fun conversation, man. Jude specializes in the infrastructure space, and we'll try to look for the synergies within infrastructure and tech and AI. So I'm really looking forward to this conversation. And this might not be your day to shine. It's okay. This is not finance. Hey, don't worry, there's room for everyone. But without any further ado, please, Jude, introduce yourself, man. Introduce yourself.
Of course. Well, very happy to be on today with this two friends turned PE fund managers turned brothers turned what we don't know yet, but we're hoping for the so my name is Jude Mullen, and I'm a private equity associate at Newberger Bergman. A little bit about my background. Of course, I'm from Nigeria. I went to high school with these guys as well too, so there's history there. I did my college and my master's here in the States. I went to the University of Kentucky for my undergrad, and I went to Vanderbilt University for my master's. Fun fact is that I actually started out as a geology major, so I was doing rocks on the side of the roads and hammers and field trips, and ultimately decided to hang my rock hammer for finance and for suit and ties. I think it's worked out very well so far. At the start of my career, I started at Bank of America, Daily Securities in the investment bank. There, I did public and private financing transactions. So think about some of your Series A, Series B, Series C for the kind of companies that you'll think about, but also IPOs. And then you all talked about Reddit IPOs, the Reddit IPO a couple weeks ago. So that would have been my bread and butter for the better part of a year while I was at BOB. Got to work on some really cool transactions like the landmark Kenvue transaction, and some other nice IPOs of the sorts. Now I'm focused on infrastructure investing primarily. And what I do all day, every day is probably three things. The investing aspect of things, which is looking at transactions, deals, and then there's also the fundraising side of things too. Looking at how can we get more capital to invest it, of course, because our ability to invest is contingent on us having capital. And finally, I do some strategy stuff for my team as well too. So a little bit of everything, but ultimately a nice mixture.
No, thanks. That was a very detailed, probably one of the most detailed intros we've had on this. So yeah, you definitely came prepared. But yeah, so you mentioned, of course, you work in a firm that focuses on infrastructure. Um, so I'm more curious, like, can you highlight like what are some of the kind of like key market dynamics? I mean, and like, can you highlight your role in what you do? Like, do you focus more on due diligence side of things? Do you focus on the financial side, the technology side? Like, what exactly do you do for your firm, and how does that play into the overall picture of the company?
Of course. So I like to say I'm an associate and I'm paid to do anything and everything my boss tells me to do. As such, my job description can change on any given day. But where I focus my energy, one is on reviewing opportunities and diligence. So when we get inbounds,
Okay.
really prepare. There are multiple stages, right? The first stage is typically prepare something that's called an IRC memo, which is a kind of a screener. This is to start a conversation with the platform, right? This is something that we're looking at. What are people's thoughts, right? Is this something that we should pursue further? Should we do more work around here, or like are there, visceral reactions to this deal that we know that we shouldn't be wasting our time here anymore? And after that, we then go to a full committee that's preparing a full memo, typically over 100 pages. It goes through the investment highlights, the competitive analysis, the landscape of the particular industry that we are investing in. What the terms of the deal, valuation, what we think about the base case, the downside case, the upside case. We put in a lot of work to do all that to really present our case to the investment committee. Ultimately, at least at Newberger, the committee has 13 or 14 people, and it's a lot of people to inform and to give them the required information to make informed decisions. So that's one aspect of my job. Takes up a good amount of time. And then the other aspect is fundraising and strategy. That is thinking about how do we get more capital in the door, what kind of fund structures, thinking about things like the proliferation of evergreen vehicles, which has become a new phenomenon in private equity as a whole, right? Thinking about where capital is it Switzerland or is it in the Middle East or is it in Iowa? Who knows, right? But we have to get into the door basically, and so that's the other part of my job.
Okay. No, thanks. And I know I decided to ask some questions, so but I'll just ask this one real quick. So you mentioned that, I mean, during your initial stages of research and stuff, you look into the companies. You said the stocks as well. So, and I think I heard you correctly. So are you talking about like, do you guys also like look into current public companies and like opportunities to take them private and grow them and scale them, take them like, what exactly did you mean by that?
So it's a range. I would say most of our companies are private already in general, but private equity firms also do take private transactions, right? Usually there are public companies that are merged by some sort of operational deficiencies, when there's an opportunity to create value and to revamp the businesses. And even infrastructure is no different as well too. There's some of those businesses there that are infrastructure like that have gone public and probably are interested in as well. And there's a chance to either adjust the capital structure, infuse additional capital to spur growth and to ramp up revenue where it's either flatline or it's reducing, or to take it private and do some more acquisitions and consolidate and make it bigger and better with stronger margins and a more defensible market position. So it's a bit of both. I would say the vast majority of our transactions are private companies or private products.
Yeah. No, I think that's spot on. I mean, last week we talked about, on the other side I talked about Thoma Bravo, right? You probably know Thoma Bravo as a firm and how they bidded for Everbridge, which is a current public company that are trying to take private, right? So yeah, I just wanted to make sure I heard you correctly when you said that. But yeah, I mean, Edison, over to you because I know you know.
Yeah. So I mean, you already know our background, right? We are PE guys interested in like enterprise software. So someone rocket science know that there's very different worlds as far as the structure, how transactions look like. We give you the example of Thoma Bravo taking Everbridge private. They are probably looking at cash flow valuations, and Thoma Bravo is obviously enterprise software as well. How would that have looked like? Well, take us back to deal flow. What's sourcing deal flow like in infrastructure space? I'm very curious to find out what that looks like compared to how we see things in the enterprise world.
Of course. So infrastructure is very interesting, right? Because I think there are two types of infrastructure, right? So there are brownfield assets. These are typically already operating assets that are usually cash flowing, where you might use some capital to either grow them or to make them larger and more. But basically, you already have the assets and they're already in the ground, right? There may be some more work to do. And there are greenfield assets where you're starting things from scratch, right? Yeah. It's like your renewables developers, right? Those kind of business models. So infrastructure is kind of interesting because you can pick and choose your risk profile and your appetite and all those kind of things, right? In terms of deal flow, it comes from anywhere and everywhere. And that's the truth. My company runs a very GP-centric model, so we partner with other private equity firms in doing transactions. But instead of the ultimate sourcing in a private equity firm, it's a factor of relationships. I've heard multiple senior people in private equity typically say, when a banker calls you, at that point, you're probably really going to pay too much, right? So a banker calling you means that it's a live auction, right? It's being shopped around broadly. and even I, as a former previous banker, I know the tactics to that banks use to
they don't know what talking to. They don't know what talking to.
Precisely to raise price and to get and to deliver valuation expectations for their clients. So it's twofold, right? It's the auction market for assets and for transactions, and then it is you going out and actively creating your own transactions. As you see a company, you're like, this is interesting, right? And the incubation period for private equity deals sometimes it can be as much as 10 years, right? You can be following something for a lot of years. Recently, had a meeting with I think it's KKR, and they're talking about the deal that they had done with a massive deal out of Europe, really transforming the telecommunication sector. And they had been working on this thing for probably 10 to 12 years. Like, it just separately and thinking about how can this work and what can we do and can this work, So in this kind of transaction, you are creating a deal out of nothing, basically, right?
Yeah.
By bilateral partnerships and figuring out where everybody is comfortable. So those are also very interesting. So yes, you get a flavor of different funnels for opportunities.
Interesting. It's quite. I can see some mirrors to enterprise software. So the greenfield versus brownfield could be greenfield being very VC stage softwares that yet to prove that technology, they don't have customers yet, and they're telling you, look, trust us, back us, and they're probably like VC appetite. Brownfield is probably more our speed, right? Or what we call our score is established, cash flowing, very probably proven technology, you have customers, and that's it. With Greenfield, I think it's quite similar, right? Investment banks send you stuff, relationships as well.
Yeah.
So I would say something that I think that's a good analogy, but infrastructure adds another layer to it, right? Because even with Greenfield,
sure.
even with Greenfield assets,
Yeah.
right? The interesting thing about infrastructure is that it is contractual,
for sure, structural, yes.
So even with Greenfield assets, even if nothing has been built, usually they typically come with contracts already
built. Contract.
So there's already some intrinsic cash value should this thing be built, basically, right? I think the model of which the venture model is very interesting because is you have to go out there and prove yourself. In infrastructure, is like you have to
show us something.
Show us something, right? Yeah. Before you go out and build anything.
One more nicer and enterprise was like, do your MVP. I can talk to us.
Exactly.
Sometimes you can say, okay, we are pitching Microsoft CSR team and maybe our customers, maybe, and that's not a strong contract, but like, okay,
it's a potential pipeline.
Exactly. You show pipeline, show your sales CRM.
Yeah, exactly. And I just I think that was a very good question, right? Try to look for the synergy between enterprise software and the infrastructure. But I'll take it a layer up, right? So I think you talked about the deal flow side of things, right? I guess I'd like to talk about the value creation side of things, right? Because I'm really interested. I was talking to Adosa offline about this because, of course, when the whole news of Bio Ogulese came out, right? You probably know him because I mean that's your space, so you probably follow him closely. And then we had looked at it like we had followed him for a couple of years now, and we talked about like what he did for the Gatwick airport and like taking over that airport, creating value by reducing check-in times and trying to get more people to the boarding stations, and so that way they could create more time for people to like shop and buy stuff. So like those kind of process optimization I thought were really interesting, right? But then again, like those are like it's very in my opinion, like those are ways to create value, but it's so minimal compared to like enterprise software where you acquire a startup, you're looking at how you scale to way more customers. It's software, right? So the scalability is quite endless, right? And of course, there's the process. There's also the process optimization side of things. There's the cost reduction side of things because it is software. So, I mean, you look at it, right? I mean, you can always find ways to reduce your workforce while still scaling on the product. So, but it's not necessarily always the same with infrastructure. So I'm more curious, like, how do you guys create value when you acquire these companies? Like, what exactly do you look out for as ways to really grow and really take that company to the next level where it really helps your top line and your bottom line, right? So like, what do you guys look out for?
It's a good point you raised, right? Because in traditional private equity, at least in enterprise software, right, the incremental cost of a customer, right? When your scale is negligible, it doesn't really exist, right? Like to onboard one other customer or to and infrastructure, there's a certain dynamics, and it occurs more in bands, right? For example, you build a power plant or utility, right? Or power generation with so and so megawatts per hour of capacity, right? 1 megawatt probably powers around 750 homes, right? So you have like there's a band in which the assets can go, right, or can be at capacity until you have to increase it. And so that's why infrastructure valuation is usually based on terminal, mature, cash flow properties, as opposed to growth. So you're not going to get a quote unquote growth valuation.
It's very cap. But you already know your maximum capacity.
Yeah.
Exactly. And then the traditional infrastructure won't think about the really hard assets type of things. But a lot of times people also forget that infrastructure is a very expansive definition, right? There are other parts of infrastructure that actually work more like your traditional private equity and so some aspect of software. Think about your growth equity. Think about EV charging. That is a very important aspect of infrastructure now, right? Even infrastructure services.
Yeah.
So your services business, some of them have software components to them which they're actually selling at advertising. So a lot of that will be valued in terms of customer acquisition, growth profile, right, and ultimately your valuation and your exit comps in terms of how you can benchmark your company or value the company against others who are doing similar things in the space. But to your point, in terms of the hard assets, right, it comes down to optimization, cost reduction, and getting incremental capacity. So in the case of Gatwick Airport, right, and Bio he said he was talking about the deal. He said, well, people who were a lot more than me figured out that we can have a certain landing and takeoff structure that allows us to add maybe 3 or 4 more planes per hour to a particular runway, right? And you talk about the check-in times, optimizing for store efficiency and food traffic and those kind of things. And when you get that on a level, these airports are worth billions, right? The value that you unlock in that is exactly. It can become very significant, and your revenue can become a lot higher by just making those incremental changes, right? I say infrastructure is all about efficiency and optimizing for capacity.
I like because it's I don't know. Which would you say is harder? Because it feels like with infrastructure, using the airport example, I can think of toll road, you think of power plants. This was enterprise software. I think one on the infrastructure side, you're getting, like you said, a terminal asset. You have a specific period of lifeline. Say this, okay, I'm going to live this for like 30 years. You already know, right? And you know that okay, this is potentially the max they can go to. But I think that the very smart infrastructure guys dismiss that and say, how can I really squeeze capacity? How can I still do more? And that's easier to think of with airports. With power plants, it's a bit hard. You want to increase capacity, build more. You need to, it's hard to scale in that sense. So it looks like you have a cap revenue upside. Now to start getting smart with how can I redesign my cost structure? How can I maybe sell what's it called? How can I get to virtual PPAs?
Exactly.
How can I sell tax credits? You start getting very it's a game. I think it forces you to get very creative about your expense line and your structure.
Precisely.
Whereas, but that's easy in the sense of you know that okay, I just have to worry about this and tweak one thing or the other. But with enterprise software, it's like the Sahara Desert.
It's everything, yeah.
You have to work on top line, bottom line, front line.
Exactly.
And then when you're working on so many moving parts, it's hard to even see what work. You have a blank canvas and then you grow this entire thing. So I like that.
I was saying like those right, like it's very hard to at least in traditional infrastructure, right? You must have done something really wrong to lose money, right? The worst thing that could have happened is that you make 2 to 3% or 4% of your money per year, which is much better than losing everything, right? And you worry about maintenance capex, some growth capex, you want to increase capacity, and all those kind of things, right? And this is traditional infrastructure. Now keep in mind there are other segments of infrastructure that function more or less like traditional private equity. But with enterprise software, it's like you said, it's a wild west, right? Because You have to focus on everything, and the upside is unlimited. The downside is also unlimited as well too.
Yeah, exactly.
Why enterprise software has IRRs in the 20 plus region, and infrastructure has IRRs in the 10 to 15 region, because it is an inherently different risk profile. And even in terms of the people who are committing capital to infrastructure, right? Who are the most active players in infrastructure? Is it pension funds, is it sovereign wealth funds, long-term patient money, right? People who are like okay to get their, their
slightly above inflation over a long period of time. You don't want the money back today. You're giving them a headache.
Precisely, right? And like infrastructure, because of key characteristics, right? You have things like inflation pass-throughs. So they're inherently already benchmarked to inflation. A lot of the contracts in infrastructure are already benchmarked to inflation. So you have inflation ramps. So when you have periods of high inflation, your earnings adjust accordingly, right? And then you have in other aspects, like in power generation assets, you actually have ROEs that set by the government, right? Like if you do things right, you should be able to make 10% on your money. So that is the difference. But there are also, and I think you're getting here. There is this intersection of infrastructure and technology as well too, right? That is happening. That has created a lot of opportunity and created a lot of investment opportunities in the recent years as well too.
No, absolutely, and we'll dive into that as well, because I think that's what will probably get some synergy. I mean, Edison knows how I feel about technology and software in general. I think, like David Rubenstein would say about PE in general, I'll just say I think enterprise software is the eighth wonder of the world. Okay, so think about how you mean.
I will beg to differ.
And that's it.
Is the first and the only wonder of the world. The pyramids, we've been around here from the aqueducts to ancient Rome, and we have power civilization, and we continue to do so today.
That's fair. That's a good counter. That's a good counter argument. I can't even fight that. I can't fight that. But delving into that, because I'm more curious, right? Because if we're being honest, I mean, prior to prior to the whole GIP deal coming public, and just seeing how much return that I yielded for Biogulis and his firm, right? Like infrastructure was so slept on as an industry. Now I don't know if it was. I don't know if that was the general understanding within the industry, but like on the outside, no one really necessarily cared about infrastructure. I mean, some people would have said it was boring. Yes, it's guaranteed kind of returns long term, but it's kind of like low margin, short term. Like no one necessarily cared about. I mean, no one paid that much attention, right? So internally, like within your industry, what are you guys seeing? Like what did Larry Fink really see that said, okay, you know what? We're going to acquire these guys for $12+ billion because we want to really focus on this market segment and this sector. Like what are you guys seeing internally like that we're not seeing? Because if I'm being honest, yes, on the micro level, I see why it makes sense, but I'm just like infrastructure. Oh my God, like I don't know, like it doesn't capture me like enterprise software captures me. Like I don't know, but like what are you guys seeing that we're not seeing on the outside?
That's a very interesting question. I think I've heard the response to that before, so I'm very curious to hear the response. But I just want to point out the joke in the room right now is that we're asking a former geologist about BlackRock.
So the rocks keep coming back in my exactly.
That's a good one.
So it's I think that's a great question, and it's something that we've been asked, and quite frankly, the GIP transaction is probably the crowning moment of a trend that has actually been happening for quite some time now. So infrastructure as an asset class is probably around 20 years. And to Bio's credit, he got in at a time where it was slept on. There was nothing. Infrastructure went from 100 billion AUM in the early 2000s, right? To now it's 1.1, 1.2 trillion in AUM, right? And over the past 5 years, it's grown at a 25+ compound annual growth rate, and it's going to be at 1.7, between 1.7 and 1.9 trillion by 2030, right? So it is an asset class that has grown immensely, right? And what the managers like growth. They like growth in AUM, they like capital availability, and they like the ability to make money. And infrastructure gives all that opportunity. In terms of the BlackRock transaction, This is the biggest, but there were a bunch of that came before that, right? So this year, we've already had probably like 4 high-profile acquisitions. BlackRock, yeah, BlackRock being the biggest with JIP, 100 billion of AUM, right? General Atlantic, which is another premier private equity firm, acquired, Actis for an undisclosed amount, right? A bunch of other transactions have been announced. Renewables managers out of Germany were consolidating, and people were spinning off their infrastructure arms to larger businesses. And the idea is that these larger platforms, in terms of private markets, are well equipped, one, to raise capital, because over the past couple of years, even as fundraising was slightly bit depressed, you saw that the larger managers were the quickest to raise capital, and they were the best positioned to weather even fundraising droughts. I'll give you an analogy. Currently in infrastructure, there are around 650 funds live targeting capital, right? Targeting capital. And the largest 10 of those funds, by their fund size targets, accounts for 40% of all the capital out there, right? Mm-hmm. So scale becomes incredibly important for these kinds of managers in that sense, right? And when you have a BlackRock and a GIP, BlackRock they have conquered the public world, right? And they have the wherewithal, they have the capacity, they have the resources to be really able to turbocharge it. And you have GIP, which is the premier infrastructure manager in the space, right? Like that is a match made in heaven right there, and they're likely to cause some consternation for some of the other players. So to answer your question about what people are seeing, well, they're seeing the growth in infrastructure as an asset class, because infrastructure is not only supported by private capital, also a lot of public capital as well too, right? It is underpinned by public-private partnerships, government tax credits. So all of this make for a really attractive place to deploy your capital and to make a lot of money. Second, infrastructure requires a lot of money to begin with, right? And so as managers raise larger funds, you're able to charge more fees, your management fees, right? You're able to make more money out of it. And I think the last part is that infrastructure is evergreen, right? In the sense that even during economic depressions, or even during times of difficult markets, infrastructure continues to go solid. Even over the last couple of years, when we saw some parts of the markets close and private equity returns, infrastructure continues steady. So it is, and to that point, when we talk about infrastructure, we talk about the correlation to other asset classes. It's very lowly correlated to other asset classes. So it creates diversification benefits. And once again, big money players, the sovereign wealth funds, the pension funds, this is what they're looking for. And there's a lot of money to be made in the industry.
Oh, spot on. Okay. Jude really came ready to back it. Okay, you're handling the pressure well, man. I like it. That's good. So you kind of mentioned the center point between infrastructure and technology, right? And I think let's delve into that a little bit, right? So, I mean, I think for any industry of a firm that's going to then look into the scale, I mean, you're going to be doomed in the short term if you don't look for ways to integrate into technology, into your product or platform, right? I mean, it's a no-brainer. So within infrastructure, like what are those areas where you've seen technology really coming in play? Because I was telling Edison about this the other day. I was telling Edison about this earlier. I was listening to this real estate mogul, and he's also a PE fund manager, giving a speech at Columbia University or so, and he was talking about opportunities for technology and AI in the construction space. I mean, highlighted some key firms that are really building some interesting stuff. He talked about this firm that was building something that would literally highlight areas of main risk when it comes to construction, like sending alerts, okay, you know what, this beam is not too strong, it could collapse in the next hour or two. So like those kinds of technology and AI and products that can take exactly, that could revolutionize construction and real estate industry to the next level, right? So and that's just pretty much technology made in real estate or construction. Where do you see technology really coming in to support the infrastructure space?
So I like to rephrase it. I think infrastructure is coming in to support technology.
Yeah. This guy.
it's actually the other way.
This guy's a patron saint of infrastructure.
And AI is probably the best example of this partnership. And we've seen other examples: telecommunications, mobile phones, and towers, and 4G, and then 5G, and we're still waiting to see what 6G is going to look like. Let's first roll out 5G, right? And AI is probably the best example of that. And what underpins AI? It is critical infrastructure. The AI revolution is probably one of the, if not the biggest revolution in terms of technology in the past, I want to say 25 years, maybe even more, maybe even 50. And AI can only go as far as the underlying infrastructure supports it. And what is the underlying infrastructure?
Yeah.
It is telecommunications, it is data centers, and ultimately it is power and energy to make sure these things are running up and they are functioning. That is probably the best example I can give you right now of infrastructure supporting technology.
Technology. No, you know what? I'll actually agree with you on this one. As far as infrastructure supporting AI, because you're spot on. I mean, I think a lot of things a lot of people get wrong is thinking that AI just really started in this past 10 years. No, I mean, like there have been a lot of physicists and researchers doing a lot of work in the AI space. Some that was called machine learning for years, right? And going back to the 70s and 60s, right? I mean, on 70s, 80s and stuff, when there was still like technological revolution before the main 90s boom, but they couldn't progress to that level because the underlying hardware or infrastructure couldn't allow for those, I mean, for what we see today. So we have the likes of ChatGPT and OpenAI and stuff today based off the infrastructure, the likes of I mean, you can talk about the power and all this stuff, but also the likes of what the NVIDIA provided on the hardware as well. So it's everything pretty much is what supports the AI that we see today. So I do agree with that. But digging further into AI now, right? Because everyone's talking about this, everyone's raving about this. They're calling it $1 trillion sector, what it could be in the next 5-10 years, and that's fine. That's fine. I mean, I do have my own views on that, but I think I think it's going to be an interesting journey before we get to where a lot of folks think we're going to get to, because as it is right now, we're still like the first inning of AI. Like we're still really just breaking into it. But for what infrastructure brings to it, like where do you really see infrastructure supporting AI? Right? Because I know we talked offline before this. We were talking about the power consumption. How, I mean, there is a ridiculous amount of infrastructure that goes into supporting AI and the data centers and all this stuff. But can you just dive deeper into that? Like, just break it down for us. How do you see infrastructure supporting AI?
So I'll make it simple, and I'll use an example of when you send an email or when you send some sort of digital document from your phone or from your computer. And usually it goes to some tower, things off of it. It goes to some data center where the equipment and data storage process and storage and ultimately delivered through the same channels to the final end users, right? That middle aspect of the value chain in terms of transmission and storage of data is all critical infrastructure. Data centers is probably the closest to the AI as a whole, but what then underlies data centers is power and energy, right? And for the viewers to explain what a data center is basically a building, usually a very large building. It has two components, right? It has your shelves and where you really stack your IT equipment and your fiber wires and a lot of and then it has the energy components, that's your generators, your utilities, and then it has a cooling system, right? Because of you use so much power, you use so much heat, you have to cool the system.
Yep.
So one data center can use the power in an hour that thousands of homes would use. That's how much of an energy intensive process it is. Now AI has introduced additional complexity in terms of demand for both data centers, which in turn drive power demand as well too, right? Currently, only about 20% of data centers are being used for AI, right? But that with the way things are going,
That's already high. So
exactly.
That's already high, like 30%. Geez, like yeah, that's already high.
And with the way things are going, right, the production of AI is going to make that much higher, right? And so critical infrastructure is needed, one, to adapt the current data centers that are already built in play, and to build one to meet additional demand, which is so critical in this for the proliferation of AI, right? If there aren't enough data centers or enough fast enough data centers to process AI, then your ChatGPT is always going to be buffering. Then your AI application and your end use cases are always going to be suboptimal, right? So a lot of investments are going into the digital infrastructure space to support this AI revolution that is currently going on.
And I just have please because I could go on and on about it. So just if you have any questions in between, just chime in. But I'm really interested in what you just said, because yes, you raised a good point about what the power consumption numbers could look like years from now, especially with AI, right? And what the GPU cards consume on a daily and weekly basis. It's ridiculous. But on your end, on the infrastructure side, like for those big players, those heavy hitters in that space, like what are they looking at? What are they looking at as the core source of power generation? Like, are they looking at the traditional means, which is the regular power generation plants and stuff, or are they looking at renewable sources? Like you have the Teslas and stuff, like who provide the part, like the battery mega packs, like and I know they've set up some major mega packs in California and Australia and stuff, right? That literally powers cities and stuff. So like, are they looking at those means to power this data centers, or are they looking at most of the traditional means where it's regular power generation?
I think the answer is all of the above. I think everybody likes to have an ideal world where all our power is renewable, but we're not quite there, right? Yeah. So it's a combination, and even data center developers are increasingly looking for one, sustainable power and reliable power, but also green data centers. That is data centers that are actually what you call, where the power sources are more from the renewable sources and less reliant on traditional, fossil fuel power generation. But the power mix, as it currently works, it means that it's going to be a mixture of both sources, right? For example, Loudoun County in Virginia is probably the data center headquarters of the world, right? The United States, for context, has around 32% of a third of the world's data centers, and a lot of them are located in Northern Virginia, right? And in Northern Virginia, the energy consumption between 2010 and 2020 increased 500%, not because of the population increase, but because of data centers. Now, PJM, which is the regional transition organization, exactly, is requiring their subunits to start providing 15-year forecasts for energy consumption, as opposed to 5-year forecast that was previously required, because of the amount of the power intensity that is required for these data centers to power your ChatGPT and to power all of your end use cases, right? And to allow you technology guys to meet your returns and your beautiful money multiples, right? So critical infrastructure here it cannot be flogged enough how much this is important, right? Currently in the world, around 2% of global electricity consumption goes to data centers, right? In a few years, by 2030, it could be 4 or 5%, right? In some places like Ireland, around 17% of their current electricity goes to data centers, because there's a very high concentration of data centers in Ireland. By 2030, that could be actually 30%, because of how much data center new builds they have planned, just because of the incredible amount of demand that is coming from the evolution of AI and the need for data centers and additional power to support those data centers. Now, I'll give you one other example of why infrastructure and technology are so codependent, right? Currently, the traditional data centers, the capacity is around six kilowatt per hour racks, right? So a rack is basically one shelf of what you put an equipment. Right? AI racks, the hyperscalers right now, which is where most of the AI capacity is, they're around 36 kilowatts per hour, right? So you see the power differential, and those ones are the forecast to get to 50 and even higher by 20 in the next few years. That just shows you the amount of energy that is needed and the amount of space that is needed. Because as these racks become a lot more dense and the power requirements go up, you also need more cooling. It's kind of a reinforcing circle, right? And infrastructure is the only sector that can address this critical component of the technology value chain.
This looks more frightening to me than bullish in the sense of I think there now has to be a lot of R&D on because I don't think this is going to stop anytime soon, right? If we're just at the inclusives of AI and we're already looking at this kind of demand, I think we'd have to figure out more efficient ways to generate electrons. We get because I don't think there's enough natural gas, enough solar, enough space for solar, like maybe nuclear comes back into the mix. But the demand looks so crazy. But I mean, that aside, you said about codependence. But I think from this conversation, you've kind of managed to convince me that infrastructure has enterprise software by the by the jaws, so to speak. Because infrastructure should say, but at the same time, software is providing the demand that is making infrastructure boom. Because if this wasn't happening, all we'll be doing is maybe remodeling a power plant every 10 years,
Exactly.
to do like
Exactly.
or doing like a toll road every 10 years, just general for our regular use cases. But software or technology boom definitely help infrastructure like grow like crazy in demand. But at the same time, we talk about like the Netflix, AWS shutdown and things like that. Any small hiccup with infrastructure, technology is handicapped.
Quite literally. And you've seen when everybody comes to Twitter and says Instagram is down, right? Yeah. And typically that has to do with quite some data centers not functioning at capacity or some critical errors at data centers. And even when they build data centers, they build in something called redundancy, just because of how critical.
You also have to connect the two data centers at the same time.
Exactly, right? And they have to be something looking at it apart so that you don't have
location risk.
You don't have location risk, and you have to have sufficient power backups and those kind of things, right? Because your ability to send an email and to scroll through Instagram and to even see me on this podcast on the internet is quite dependent on infrastructure. And what that boy is looking at me and saying I've convinced people to become infrastructure fans. Like my entire point and my entire idea is to really show the critical nature of infrastructure, even in technology, when people may not necessarily see it.
Speaking as a business person, I think it's for another question. Why doesn't and you may not have the answer for this, but why doesn't infrastructure get more greedy? If I knew that, if you study any industry, once you know that, look at agriculture, once you know that you have, in this value chain, and you have your suppliers, the suppliers demand on you critically, but your suppliers are also making crazy money. NVIDIA is doing, creating $1 trillion valuation every freaking 3 months, right? Why doesn't infrastructure get greedy and say, you know what, I kind of want to own stake in that as well. I want a piece of that, but I don't just want to be I'm building your boring asset that makes you grow, triple freaking digits every 3 months. Mm-hmm. Why don't you want to get some exposure to that more high reward sector?
Because you'll be changing the vision of infrastructure if you did that, right? Hard assets, inflation protection, right? Yeah. What happens if, for example, if I don't know, the AI revolution takes a back seat, right? So there's so much risk, and infrastructure only goes commensurately with demand, basically, right? Because we don't want to be going in the backward direction.
Volatile.
Exactly, and you don't want stranded assets. And that doesn't mean that doesn't happen. Like a lot of coal plants stranded. But that's intentional, right? Because we're transitioning to a more green economy. Right, and so those kind of decisions have to be made, right, to shut down power. But in the case where if demand should reverse, right, and then you have all these stranded assets, and then you have to start figuring out that infrastructure start losing money.
Because like what we're talking about right now, well, assuming that ChatGPT AI is really going to be a success. Remember when people tried to push VR and that kind of thing, it's coming back now. But like, what if there's a real? I mean, do you guys factor that? Do you guys talk about that in your meeting? Like, what if ChatGPT goes broke today? What happens to like all the
OpenAI, to be fair. Yeah, OpenAI.
Infrastructure is always behind. in terms of capacity, right? So like so we're trying to catch up on it, and so like there's a lag period for those kind of things. And I think it's a kind of a foregone conclusion that OpenAI is just one example, right? And Amazon just invested into their AI, the AI company, and put another few $1 billion in there, right?
Yeah.
Last book reported that AI investments totaled 29 billion, right? This is almost 250% more than the previous year. So I think it's clear that this is here to stay. And even minus AI, right? Like the need for faster computing, right? 5G, all this kind of technological developments to improve speed, reduce latency, right? All of the things, exactly. All of the things they are already baked into the equation, right? Because those things are almost foregone conclusion at this point, right?
In that emerging market, we still need more.
Yeah, exactly. And the emerging markets, you're not necessarily doing this here. There are a couple steps behind there, yeah, exactly. Right? And you can transfer infrastructure skills from developed markets to developing markets and get up to speed there and improve demand in general, right? So to answer your question, right, if infrastructure started taking all that risk, it will fundamentally change the asset class and the risk profile of the people who actually want to invest in infrastructure.
Sure.
Right? Not everybody wants to invest in infrastructure. There are constituents who want to invest in infrastructure, right? And he wants to put all of his chips in enterprise software, which I would advise against. I think you need some.
I didn't say that verbatim. I didn't say that verbatim, man. But then again, that's what I have this conversation is, right? I always start to be educated, but
like so people who want long-term exposure and those who have a flavor. So those same guys probably have less exposure to software.
Exactly.
And so I guess right. They want different managers to do different things.
Pretty much.
So we just address their professional appetite.
And so when you think about portfolio construction, right, you have your highest risk enterprise software given the location. And you have your safer best infrastructure. You have the fixed income, government bonds that I'm just going to get my 5% a year in this high interest rate environment, which is probably going to go down here very soon, right? And you're constantly moving that around, right? I think in the last few decades, we've seen a higher allocation to alternatives as a whole, which is private equity, infrastructure, and private markets that people have sought to find additional alpha ahead of what above public markets or fixed income and equivalent fixed
income. Okay. I mean,
you want to say something about?
No, I mean, I said my opinion is still my opinion. I still respect all the industries. I mean, don't get me wrong. I think if there's anything at all, I think I've learned a ridiculous amount of infrastructure just by this conversation, right? So, no, like I'm actually going to do some more research offline about infrastructure because I think you've actually highlighted a very interesting things, especially when it comes to how infrastructure actually supports technology, not the other way around. Right, because I've always thought about it as everyone needs technology to support their business, but you kind of highlighted how instead of doing around actually for infrastructure. So I think that's really interesting, and I'll dig more into that offline. But my stance is still software is it's wonder of the world. That's still my stance. But anyways, but I mean, I think that's pretty much bringing us. I mean, towards the end. I mean, we probably can't dive into every single thing, and I'm just being respectful of your time. Edosa, I mean, is there anything else that I haven't? I think I pretty much asked the main ones already to ask, and I think I've got a lot of answers.
Well, I guess to round up, give us an idea of what you've helped us understand deal flow, helped us understand your due diligence side of things, and we got to see the different aspects of infrastructure, and you've convinced us, or you've convinced some of us that infrastructure is the only wonder of the world, right? But now, post-investment, you guys have done all these steps. You've now invested. What does post-investment mean? What does operational day-to-day look like for maintaining your portfolio investments?
Yes. So it's a few things, right? It's budgeting. It's planning out capex very, very intensely. By thinking about maintenance capex versus growth capex, and also adjusting based on macroeconomic conditions, right? If something is depressing demand, it's kind of silly to go in there unless you are proactively doing growth capex with the full understanding that on the other side of this demand will be great and will be robust. And we saw some cases of those infrastructure, right? Some like airplanes, for example, leasing and parts of those kind of things, right? During COVID, like it seems like that whole industry went to zero, right? And some really smart people took bets that like when we come out of this, there'll be a lot of retired planes and a lot of new capacity, and basically everything coming back online will be support. And people took proactive bets and steps to address that ahead of time, right? And sometimes that's how infrastructure works as well too, right? It's optimizing for the future, even though you might take some current pain. So it's monitoring, it's optimizing, and it's financial engineering, so to say, moving along with the macroeconomic realities. But ultimately benchmarking yourself against competitors, against similar assets, to understand where you are quite meeting your benchmarks and what you can seek to outperform, whether in terms of margin improvement or even structuring the contracts and changing the risk profile of your contracts.
But can you see that? You see how? So once they send the check, they basically just respectfully, they're basically just kind of getting check each quarter or whatever. Like post investment looks very structured. But no, you talk about post investment. Give some insight about post investment for enterprise software. You're calling your CEO every month. Hey, what's the monthly report for this? Why did marketing go down? What's your marketing team doing about X, Y,
Z? Exactly. That's all enterprise software, man. That's all enterprise software.
There are complexities in post investment as well too, right? Because you have project finance, you have debt, you have to optimize for your governance as well too, right? Yeah. So we're not just sitting on our chairs and watching Netflix when an investment is right? You still have to do all those things that optimize your capital structure for things and find a way to grow demand or grow contract value as well too. I'll give it. Maybe we're not like knocking on every door and trying to sell somebody a new software. We may not be knocking on people's door, and in some point people are doing that, right? Like if you're trying to have an EV charging space, right? But you have to it's a land grab type of transaction, right? So you have to go knock on your McDonald's or where you can locate some of these chargers. But in traditional infrastructure, at least, it's all about optimization and utilities. And making sure your margins are fine and you're optimizing your expenditure.
No, spot on. I think there's nothing else to end on is just that after this conversation, let it be known that Jude is not allowed to change industries. At no point, if you leave infrastructure, there's a problem. I'm going to fight, man. There's going to be a problem. I'm going to fight.
AI keeps proliferating and we have things to do. I'll retain my seat.
No worries, man. Nah. This has been an awesome conversation. Definitely beat the expectation that I had. And I'm glad we had this conversation. So Adosa, thanks for making this happen. But yeah, I think we just round it up there. I'm sure the listeners are going to enjoy a lot from this because. Yeah, I mean the same way that we've got this information and looking for the intersectionalities between infrastructure and technology. Yeah, it's really interesting. There's a lot more research to do. We're probably gonna have way more conversations offline, just trying to really understand more about this space and how we can both create the ninth wonder of the world. But thanks again, Jude, for coming on. It's been an absolute pleasure having this conversation with you. For the listeners, you guys know what to do. Let us know your thoughts, your feedback. Jude, where can they find you on LinkedIn in case they have any questions? Where can they find you?
Jude Omodo on LinkedIn.
Absolutely.
I'll be happy to answer any questions.
Awesome.
Or if you have people to invest, I'll take that too.
Hey, take everything you can get, man. But yeah, thanks everyone. We'll go ahead and wrap it up for now. And you guys have a good rest of your week. Stay blessed and stay safe. Bye-bye.